We're going to talk about some changes that are in the life insurance world at the moment.
G'day everyone. Dan Blatch, Director and Life Risk Specialist at IMFG. Live and breathe life insurance. Occupational therapist by training, so I love helping people in this space. For my sins, Glenn.
Is this true that I'm having a coffee?
No, you stay awake. I guess what's really interesting, and you've heard me sort of bang on about this for a while now, Glenn, is that I'm on a bit of a crusade to try and make sure Aussies have got their protection around the right way. And I know you've sort of been on this message with me for a while. And if you think about it, I've been saying for many, many years now, your ability to earn an income is without doubt your most valuable asset. But unfortunately, Aussies have sort of not quite got that message really. The stats continue to show year in, year out. And a simple little example we talk about is, 98% of Aussies have got car insurance. What's the average value of a car? I don't know, 20K or something like that, depending on where you live and what you want to drive.
Yeah.
I know you love your cars.
Love my cars.
Yet, you can't claim for your employer, you can't claim a deduction for your car. 80 odd % of Aussies have got home and contents insurance. Yet again, average price of a home, it depends on where you live, but, Sydney, Melbourne, $750 or $1 million, whatever it is. Yet, a 25-year-old today earning 40K per annum is going to amass more than, literally, I think it's like $4-something million in their working life. A 30-year-old today earning 60K per annum, assuming no salary increases, just CPI, is going to amass more than $3 million. Yet only 20% of Aussies have thought to protect their income. So something's going on there philosophically about us getting that order right. The important thing with income protection is if you own and fund it yourself, as you know, you can claim a full tax deduction, whereas you can't do that with your car and your home and contents. So I'm on a crusade to sort of try and educate more people about that. But what's happening at the moment is life insurers are bleeding money when it comes to their income protection books. So in the last 5 years of the 11-ish life offices in this country, the income protection claims departments have lost just over $4.3 billion.
Wow.
And so the main contributing factors to those, according to APRA, are over-generous policies and also an influx of mental health claims for white-collar folk and musculoskeletal claims for blue-collar folk.
And in the background as well, the record low interest rates. So life insurance companies, when they've got the premium pool, they're risk averse. They're not going to put the pool of money into shares. They're going to be in defensive assets that don't yield a high return anyway.
Exactly.
So it's just a compounding issue at the moment.
Yeah, and we've got this sort of perfect storm brewing,
Yeah.
Unfortunately. What does that mean for you? Well, I guess there's sort of two sides of that coin. One is if you're an existing policyholder, if there's only one thing you get out of this today is you're onto a good thing.
Yeah, don't touch. If you've got a policy set up, please
don't touch
it. Don't.
Exactly,
Yeah.
or certainly don't cancel it.
And we'll tell you why. So.
Exactly. So long story short, it's very rare that you get a government department intervene in private enterprise. Very rare. And depending on what philosophical view you have, but some people say we're getting a little bit too socialist there if that's where we're going. But what it essentially says to me, something serious is going on here. And obviously the Australian government want a sustainable and profitable life insurance market because there's a vested interest for them, meaning less people will be on the welfare purse should they suffer from serious illness or injury. So really, Australians, generally speaking, need a successful and sustainable life insurance market. But because they're losing money hand over fist, APRA have had no choice but to intervene. So they've run this investigation. They've essentially deduced that some of these policies are just too generous. And so they proposed, and late this year, they're going to come down with those final amendments and proposals. They've proposed a series of interventions to life insurers and saying by a certain date, we need you to have amended or at least ceased offering certain benefits in policies. And so I thought we'd just quickly run through them now, Glenn. The first is, which has already occurred, it happened on the 31st of March, is the cessation of what we call an agreed value income protection policy. Essentially, there are two types of income protection policies, one being an indemnity income protection policy and the other one being an agreed value
Similar
income
to
protection
your
policy.
car insurance. Do you want to insure your car for the market value, which could be $20 when you have the crash, or an amount that gives you certainty at claim time, which is the agreed value?
Exactly. So what they're essentially saying is they've had a lot of these mental health claims with agreed value policies that go for a long time on $20,000, $30,000 a month, where the insured at claim time might have only been able to justify a lower amount, but because they've got an agreed value policy, the insurer must pay that agreed value amount when they provided financials at the application time. So I guess there's an argument to say that is too generous a policy, and it's one of the first things APRA's decided to do. So we've already seen the cessation of that. So key takeout, if you've got an agreed value policy,
keep it.
Keep it.
And it speaks to why it's so important to have a financial advisor in your life. So I would say if you are, COVID, it's affecting everybody. If you are doing it tough and cash flow money is an issue, please just don't call your insurance company direct and say, oh, I want to cancel the policy, I don't need it. Just have a chat with Dan and the team first, because there could be other options to reduce the premium. Because once you come off agreed value, if you've got an agreed value policy right now and you come off, you'll never get that again.
Yeah.
And that's a big issue, but it's not the bigger issue. There's two other issues at play that's happening in the income protection space at the moment. Talk to us, Dan, about the issue of guaranteed renewable.
See, this is actually, I think...
This is the bigger issue.
I think this is probably the bigger issue. Yeah. So unlike a general insurance policy, life insurance has always had this feature of guaranteed renewable. So what does that mean? It essentially means you go through the underwriting process up front, which we highly recommend, getting all known information to the underwriter up front.
You sign a contract with the insurance company.
Contract with the insurer, and then as long as you continue to pay your premiums, they must renew your policy at every anniversary date. Unlike, say, a home and contents policy where, let's say I lived in Darlinghurst ground floor studio and it was sort of, on a passageway and I had 4 or 5 break and enters, that general insurer has the right, for argument's sake, to not renew your policy. It's too dangerous, too much of a risk. It doesn't exist in life insurance. But again, APRA have said, that sounds a bit too generous. And so they're proposing by 1 July, they're mandating all insurers no longer offer guaranteed renewable contracts. So what does that mean? At the moment, they're proposing, and these amendments aren't finalised, that they might offer you a term contract. So Glenn, you go and talk to your advisor, he or she recommends you take out a policy, but the terms for that will only be, for argument's sake, for 5 years. At that point, the insurer will have the right to ask you about your occupation and your income. Again, importantly, they're keeping health off the table, which is a great result. But what does that mean? Let's say I was an employee, I was earning 100K a year.
In an office cubicle.
A cubicle. And then up for renewal, I've actually, in between that time, I've gone and worked for myself, I'm running a consultancy job, but actually my financials only justify, say, 50K a year. They actually will renew your policy, ask you those questions, but you'll only get the 50K a year moving forward.
Yeah.
Or you might have been on mat leave and your earnings have been impacted right at the point of maternity leave, you will only get the smaller amount of income.
Another thing that's I think is significant as well, so my income protection policy, it's AAA rated white collar. As it stands at the moment, my policy, I could literally tomorrow get a job in a coal mine, work 2 kilometres underground, hurt myself underground, and they would pay the claim. Now, if I, for example, thought, I need to get into some manual labour, I want to go and chase some dollars in a mine for a few years, if the 5 year comes around and then I'm working in a different, more high risk occupation, they might say, okay, 5 years up, we're not offering you insurance anymore, and cancel the contract.
Decline. So that's a huge moment. And Glenn and I were joking off camera actually. Insurance nerds like us, this is like a Woodstock moment, really, in life insurance. So again, key message, you have until the 1st of July, if you're not an existing policy holder, to get some protection in what we call a policy which will have guaranteed renewable, or if you've got one, stick with it, because
Yeah.
after 1st of July, I think the quality of the contract, or at least the security and peace of mind you get from the contract, just isn't as...
Now, it's important to note as well with that, Dan mentioned the medical stuff is off the table at the moment that we know of with the renewables. For example, I've bunged my knee. I've had some surgery. If I walked off the street and wanted a new policy, they would say, well, now your knee's a pre-existing illness, so we can't cover your knee. So what they're saying is if your income or occupation did change at that 5-year mark, they're not going to exclude the knee at that time. So your knee will still be insured. If you had surgery and you did claim on your knee, the medical side is still locked in at the moment.
Yeah, exactly. And I think probably one that's the writing on the wall that you know, and for many years I've preached the benefit of, if you're younger and healthy, take advantage of paying less premium in the long term, rather than this idea of, as you know, two ways. At every anniversary date, as I get older, the insurer will reprice my risk because I'm at a higher risk. We're already seeing it now. One of the life officers in the country has decided to cease allowing that level premium option on income protection. Now, this isn't APRA mandated, but you can see that the writing on the wall is there around, again, people saying these contracts are too generous for too long. So we're going to begin to stipulate how you can elect to pay for these premiums. So once again, I mean, it goes without saying, if you've got a level premium policy now,
it's funny. My income protection policy, it's level premium because I set it up in my mid-20s. It's agreed value and it's guaranteed renewable. I will be taking this policy to the grave, basically, because I'm not going to get one that is that generous ever again. And it just speaks to, I guess, in a broader issue, the Australian insurance market is very small. And so if the population of Australia is 27 million people-ish, we know that that's not 27 insurable people because there's children and people who don't work or whatnot. Now, that's such a small pool compared to other countries. And some of these decisions that the insurance companies are mandating that aren't APRA mandated are coming from the reinsurance companies offshore, looking in at the Australian insurance market and saying that insurance market, it's just
too generous.
It's too generous,
arguably.
And probably you could say maybe back in 2005, and this is for another thing, but in the insurance world and the financial planning world, there was a bit of a ratings war was happening. So you could rate your insurance, the research houses would rate insurance policies, and then each insurance would want to get to the top of that thing and they'd add more bells and whistles, which basically means that some of the income protection policies are very, very generous.
Very generous. And they're only going to go in one direction, unfortunately. That's less generous. And I remember when I was at AXA managing income protection claims, Glenn, one of the things that really interested me was, at a philosophical level, an insurer, when you go on an income protection claim, believes that you're a better chance of returning to work full-time if you're doing some work. And so to incentivise claimants in that arrangement, the partial disability definition is such that if you're doing some work, it can be that you're actually earning 100% of your pre-disability income. Now, assuming you don't improve as a claimant, you can essentially earn 100% of your pre-disability income by doing some work, as opposed to being totally disabled and technically only earning 75% of your pre-disability income. And what we see around the world, that's what we call an income replacement ratio. And around the world, in the UK and US, you're talking 55 to 65, 70% max. So APRA again believe that's too generous. So post 1 July, it will be likely that the only ideal way you could earn that 100% of your pre-disability would be for a maximum, say, of 6 months. And thereafter, they'd move you back down to 75% or even lower. Which is another reason why, if you've got an existing policy, they're not going to touch these. They're grandfathered, all of these provisions.
So I guess in rounding out this discussion, I would encourage anyone listening, if you do have insurance already and you haven't had Dan or your advisor or Dan's team look at your policy, pick up the phone ASAP, just have a chat, let Dan run his eyes over the situation because we've got to get our skates on. And particularly if you aren't insured, and in the back of your mind, you're like, oh, I really do need to get some income protection. I really do need to review my cover or whatnot. You must speak to Dan.
The time is now.
And this is the time to lock something in that's quality for the long term.
Yeah, exactly. And I know a lot of people are doing it tough at the moment.
Yeah.
You know, a lot of people are on assistance, or frankly, just money isn't that easy to come by, and budgets. There's definitely budgetary pressure.
Yeah.
But I guess, as I said in my opening thing, I just encourage people, if there's only one type of insurance you're going to have, for me, it would be the insurance that covered my income rather than my car or my home and contents. So if you haven't got it, the time is now. If you have got it, it's a great chance to even have a review. We can tweak around the edges, pull some levers to reduce cost if we need to, but certainly not throw the baby out with the bathwater.
Yeah, and I like to say, don't make a permanent decision, particularly around your insurances, over a temporary season in your life, if possible, because there are so many things that can be tweaked on the policy to really bring those costs down, to get you through, but to keep you, what we call in the industry, on risk.
Exactly.
Because it just takes one moment and it can be too late. And on a personal note, if you have not been to your GP in a little while and you've got your insurances in place, go and have a skin check. I had a skin check. I recently had a partial benefit in my trauma policy payout because it was discovered that I had a melanoma on my leg, and it was just such a valuable thing in my life, because if it was on my face, I may have had to have plastic surgery, and I'll finish with this story, and then you can maybe have your final comment, because we could talk about insurance all day. It's weird.
Insurance nerds like us.
There was a client when I worked in Sydney a million years ago. He came in for a review, and part of the review is, have you had any medical events? And if you have had any medical events and you are an insurance client, run them past Dan, because there might be a claim sitting there that you don't know.
Retrospective claim, potentially.
He had a melanoma on his shoulder. It went deeper than my one, so it invaded normal flesh, and it basically triggered a full claim. Now, at the time, he had the melanoma taken out, surgery, big thing, blah, blah, blah. Came in for the review. I had this thing, and we're like, oh, hang on, just give some more detail. We got the histopathology. It was, half a hair thickness or whatever it was off the actual textbook of the insurance.
Definition,
And the insurance company paid the full $400,000 trauma policy. So that speaks to a couple of things. Dan, and particularly myself when I was a practicing advisor, we're not calling you every year saying, we've got to move you to this insurer, we've got to get a better deal. It's setting up quality for the long run, because when it comes to insurance, time with the insurance company is your friend at claim time, because they'll say, this client's been paying for the last 15 years.
Correct.
Yes, the black and white says that there's not really a full claim here, but we're going to do it because of the data that we've seen. So that's my final comments.
And look, you're living proof
yeah.
of evidence that you've had your policy, you've received some benefit. Thank gosh you got it this early, and first and foremost.
Well, and the beautiful thing about the trauma policy, with the policy definition, a lot of the time a medical trauma event, it's yes it happened or no it didn't. You can't half have a heart attack. You can't half have cancer. So the long story short was, I received the partial payment into my bank account before the stitches were out. And that's what the advantage is of working with an advisor who can make things happen. I just pulled on some contacts that I had, and we made it happen. So that's my final comment.
It's a great story. And I mean, I've paid claims for the last 20 years. I'm fortunately just walked a client off a cliff this week, having paid $525,000 as a prostate cancer claim for him. He's given me a hug and said, thanks for walking me off the cliff. I was considering cancelling it. Of course, now it's a great story. It's a tax-free lump sum, no time off work. So I think having a protection package that works for you into the future is important. I guess the key message we wanted to get across today was these changes are significant.
Totally.
Really think twice before we make any amendments to your existing policies, and those that haven't thought to protect themselves, we've got some
some time, yeah.
time to get something happening, but the time is now because 1 July next year will blink and we'll be there before we know it.
Totally.
Thanks for having me, Glenn. Cheers.
See you guys.
Thanks, guys.
Bye.